Well, I want to hear what they've been saying, that the economy is strong, that it's robust, and it can withstand even more rate hikes. People are worried about if the Fed raises rates, but they're only raising rates if the data is good. And thus far, the data has been strong. Now, I don't think they're going to accelerate the pace of hikes, and that's really what the market should worry about. If they come out very aggressive, then that could be a pullback.
Put on your political hat, because we're here. Do you think the president's comments will in any way influence what the Federal Reserve does?
No, I don't think at all. I think he's going to bluster, he's going to posture, he's going to try to strong-arm them. They're not going to cave. In fact, they might even dig their heels in more. Fierce independence.
To prove a point.
To prove a point. The Fed's always been independent.
The Federal Reserve, you know, as we've said, is not a part of the government necessarily.
No.
The employees of the Federal Reserve Board do not get government pensions or health care. They are basically a banking organization that operates with the blessing of Congress. So you think they're going to go ahead and do what they feel is best for the economy and their mandates, inflation and maximizing employment.
Right. And right now, inflation is a little bit of a risk with the strong labor market. Wages have been rising 2.7% for the past 3 months. That's the first we've had in almost a decade at that pace. So the Fed's going to be looking at the inflationary pressures. Part of that is actually good economic news. Strong wages, good for consumers.
When your clients call you today, hey, I saw you on Worldwide Exchange, great job. And they ask you then, what do I need to think more about? Do you tell them it's the Fed? Do you tell them it's trade? Do you tell them it's Trump? Do you tell them it's something else? Is it corporate earnings? What are the key things that we need to? There's so much going on. How do we kind of cut through it?
When you cut through it, you focus on corporate earnings. Corporate earnings is the #1 driver for stock prices. You can also look at the underlying reasons for that: a strong GDP, strong global growth. You want to look at the strength of the consumer, low debt levels, high wages, inflation is moderate. It's almost a rosy picture for stock.
Too rosy?
The warning signs are out there. One of the warning signs is that 10-year, the drop in interest rates, the lagging financial sector. This market's had a very narrow focus with tech and consumer discretionary, which is a lot of Amazon and Netflix. So if you take away that, what's the rest of the market doing? I call it a halitosis market. There's
bad breath market.
There's bad breath in this market.
If I remember the commercials correctly, Mark.
It's sort of. So what we want to see is we want to see it expand out. We want to see better breadth in the market. We want to see financials shrug off the fact that interest rates are a little low, because those two, that's a warning sign for me.